Hey, everybody. Sorry we're a minute late. Welcome to week 223. 223. So welcome back. Cotter was last week, 222. If you don't know what that means, look it up. We are really fortunate because we get to have a friend of all three of us on here, Scott Upton, the best. I'm not going to say business broker because you just punch me, but he is really a great investment banker. Does great at, like, if I was doing a deal, if I had a company to sell and I was in his sweet spot, he would be my first call. And that's not because he's on here. It's the truth. And anybody that knows Scott Upton's reputation, they can vouch for that. So anyway, we've got him on here. We're going to be talking about M&A war stories. Yes. As well as like how to screw up a deal, things that you can do to avoid screwing up a deal, how you can maximize a deal if you're thinking about selling, or, even if you're looking at buying, some of the stuff that you should be looking for. So before we do any of that, we'll go around the horn, and Jack is muted. So I'm going to go to Adam first. Adam, I know you always have something to say. So, give us some diatribe.
Thanks for that. I called Jack ahead of this and said, okay, we're gonna not talk about the debate.
Good.
Right. So of course, once I got him to agree that we would not talk about the debate, I'm gonna talk about the debate.
Oh gosh.
I'm actually not. Other than I'm gonna go ahead and share my screen real quick. You guys know that I love data. So can you see my oh, there we go.
No.
Can you see my screen, Gary?
Yeah, we can see it now, baby.
Yeah, we can see it.
Yeah, so there was a bunch of blah blah, you did this, no, you did this, greatest economy in the world, we currently have the greatest economy in the world. Well, you inherited it. Well, you have all the nonsense, right?
Right.
You're crushing stuff, no, you created a mess. And in other words, I just wanted to say it's all freaking nonsense, like both of them were nonsense. So I'm not disputing that right now a lot of people feel like, hey, things suck. Like that's a true statement, in terms of people feel that things suck. And at the same time, just a couple things that I want to point out just from the discussion, because, I think we kind of know what, most of Trump's plan is from a tax policies perspective, which would be, either keep it the same or maybe reduce it a little. The Harris campaign is, raise it on higher income people, maybe do some cuts at the middle level. And then she announced, some incentives for startups and first time home buyers and stuff like that. But here's the real data, right? So, I mean, if you kind of look at like factor out, go back to the, I think when Obama was president, at some point, it's like, dude, stop blaming Bush.
Right.
So like, if you just say, well, what's a proxy for stop blaming the last guy? Let's call it 2 years. I'm calling it 2 years. Like after 2 years, you cannot blame the last guy, for the problem. So, Q1 2018, Trump, that's the first year of the Trump Tax Cuts and Jobs Act. Like it was in effect for 2018. So, kind of first statement about, hey, what did that actually do? GDP was at 3.3%. Unemployment was at 4%. If you look at the same quarter in 2019, it actually reduced. So tax rate went down and GDP went down. So like, unemployment did trickle down just a little bit, And then if you kind of look at, well, how did we land before the pandemic? Look, I love the Tax Cuts and Jobs Act, but the fact is the GDP growth rate in Q4 2019, 2 years after it had taken effect, was no different than when it started. And
it's an interesting fact.
And unemployment was not materially different from when it started. S&P 500, rose some, 2633 up to 3244. So then when you get into like, air quote Bidenomics, which is, hey, you're all crazy, you shouldn't feel as bad as you should. Like, what do they mean by that? Well, if you kind of just, again, look at the data, in 2024, GDP growth rate, Q1, 2.9%, not that radically different from Trump's growth rate, 3.3%. Unemployment was actually a little bit lower, than the same time period under Trump. You switch over here to Q4, we of 20, well, actually last quarter we've got is Q2, 3.1% GDP growth rate, 4.1% unemployment rate, so it trickled up a little bit. S&P 500 doubled, but here's where you start feeling it is, well, yeah, interest rates do suck a lot worse,
Yeah.
8.5%, in Q2 of 2024 relative to, go back here to 2018, 5%, like that kind of sucks a little bit, 3% increase. Price of gas, we talk about that a lot, it's up, 60 cents, whatever that means, relative to Q2 of 2018. And here's the one that I thought was interesting because, there was a lot of, immigrants drive up the price of housing, and, Harris said, well, we do need to focus on making housing more affordable. This is one that did shock me, but not relative. Like average house price, under Trump, 374. If I look at same right now, 519, like that's a big difference in terms of the average home price. At the same time, personal income, 52, now at 70. So if you just look at that ratio of what I make versus what do I pay in a house, it's really not materially different, and over this entire period hasn't changed a lot, between like 6.8 at the lowest to, 7.6 it looks like at the highest, which again sucks, but it's not that big of a change. I mean, in other words, like an equally plausible argument is that, Black Arch bought up all the affordable houses and turned them into rental units, so that's just it. It's just a long way of saying that as a libertarian, they're all full of crap and none of them can actually move the needle on much of anything. So it really is more like try not to screw it up too bad. whoever you are. I think this is another one, just to kind of hit on this GDP growth rate, relative to, hey, 3.3%, but, right when a tax cut comes into effect, didn't move the needle 2 years later. And you hear people talk about the tax rate being proportionate to the deficit increase. Here's just the math on that. Like, let's say that I, in the year that I do the tax rate decrease, which this is what really happened, if GDP is sort of a proxy for sales, and the average taxable income of Fortune 500 companies is about 15%, which, the average annual income tax rate is, about that too. So 15% is a good number. That means that my taxable base is $150. At the tax rate under Trump, before he passed the tax law, it was like Scott paid 39%. Scott will remember this. He paid 39%. So he paid, $58.50 in taxes. Trump reduces taxes by 10%. So Scott was super happy about that because he put real money, 15 cents in his pocket that he did not have before. So Scott, the individual, feels great about that, as did Adam, the individual. Jack, not so much because he got screwed. But Adam feels pretty good. But the thing is, like, remember, this is what I was bringing in, $58.50. So sort of this whole thing about, hey, I'm going to cut taxes and that's going to lead to economic prosperity and we'll make it up on volume. That's sort of the argument, right? Well, look at what you really would have to do. Like, Scott would have to have 35% increase to pay in the same dollar, same amount as he was at the 39% rate. So Scott's super happy about that because Scott's actually making a lot more money. So Scott is ecstatic about that. And I don't blame Scott. Hell yeah. But as the federal government, like, there's got to be a lot of damn prosperity just to get to the same dollar that I had before, let alone both the idiot parties spent more money.
Right.
So instead of it needing to be 58.50 to cover the bills, it actually went up to like $65 to cover the bills. And as you can see from the data, I did not bring in 1,000. I did not bring in 1,350. It's more like, as a whole, I brought in more like 1,050. So it's just they're both. I'll shut up now, but it's just they're kind of both disingenuous. Like, again, what's the right answer? Who knows? But it would be great if they just were honest. I'll shut up. I'll shut up now.
So, does anybody know? And this does tie to this. So, Elon Musk said, "Man, the thing that I don't understand is everybody's like whistling past the graveyard because they're not talking about the debt, which is a real problem."
Yeah.
Along that same line, which we've been talking about that. We would agree with that. At the same time, there was a big event that happened this morning, tied to one of Elon Musk's companies, and it doesn't have anything to do with the Cybertruck.
Oh, that was super. That was super cool. That was a space.
Wasn't that cool?
Like, that was awesome. Yeah, that was super awesome.
Yeah.
I'm like totally jealous. I don't know how I'm going to become a billionaire to be able to do it, but I'm like totally jealous because that's awesome.
Yeah, I mean that's cool because when I was a kid in the '60s, I remember those spacewalks. My dad went to NASA and brought back a model of Apollo, 11, I think is what it was, or something like that. Apollo 7, maybe, I don't remember, but it was cool. And so anyway, and Udo, no, we are not doing debates or discussion, especially on political stuff on this. No way. But we are going to talk about, we are interested in talking about what's affecting businesses and business owners, which is why we're in M&A. We're going to really be talking a lot today about mergers and acquisitions. We've got a really good mergers and acquisitions attorney in Jack Santinello. We got a really good guy that does a lot of mergers and acquisitions, and Scott Upton. And Adam and I have been involved in a fair amount as well. So we are going to be talking about that kind of stuff. If you do have questions, hit us up in the Q&A. So yes, this is an open forum, but I'm just going to say we're not going into Taylor Swift or Patrick Mahomes' wife, their opinions. Okay, so both of them are on both sides. So Jack, anything that you've got going on besides you're back in Charlotte and you were in Charleston?
Yeah, well, interestingly, so listening to that, okay, I came back the night of the debate. So usually I have to fuel up with, I'm not a road warrior, so I drink a lot of coffee and then it keeps me up all night when I'm driving in the later evening hours. I knew I wouldn't need it because I knew that my blood pressure would be raised by both people speaking. So, it was the ride went, 3-hour ride went by just like that. With respect to we're talking about gas prices and stuff in that chart. What boggles me is that, and anybody who doesn't use Gas Buddy, the app,
yes,
you should use it because the variation in gas prices just in Charlotte. I mean, I got gas at like $2.85 at an Exxon down the road here, and it was like $3.29 a few miles down the road towards Matthews on Monroe. And so, but then also, if you have the ability to go dip down into South Carolina. So yes, I refueled before I came back all the way home. So yeah, gas prices variation, but my tip of the day is get the Gas Buddy app if you don't have it. I know that it's not always accurate, but it's a pretty good resource to get less expensive gas. But yeah, I mean, I'm ready to jump into the M&A stuff.
Let's
and
do it.
hear Scott's stories and everything else.
Gary, I'd rather read your LinkedIn than watch the debate.
Hey, especially when he
I would
takes his
rather
shirt
write
off
my
and hops in
LinkedIn
that plunge. Scott's like, yeah, he's got a picture of Gary up on his bathroom window. Motivation.
I hear you, but
Yeah, so I think
I'm good
Scott,
enough. I'm smart enough.
I think both of us, both me and Jack, have been involved in a lot of deals with you, and I'd echo Gary's comments. I think, our track record with Scott, has generally been, for the most part, I think he's probably sold every company that we've been involved with. What's unpredictable is which year is it actually going to close. So I think, if you could kind of share with the group, the top two or three things that you see cause delays or just like massive screwed ups or blow deals, so that people can know, like, yeah, and specifically from the seller perspective, if you kind of start out, I know there's sort of some buyer sentiment that goes into that, but really from the seller's perspective, where you're just like, dude, that'd be great.
yeah, and I think we've got a real life example of that. Adam, thanks guys for having me on. I mean, the challenge I think is really the first and foremost is having good financial statements and systems. 9 times out of 10, if your financial statements aren't good, and this goes back to you guys from an accounting standpoint, if your financial statements are not good and not in order, and your financial house is not in order, that's a big red flag at the end of the day. We've dealt with companies that do, it's best to have monthly financial statements if you can do them. We've dealt with companies that have quarterly. Then we have companies that put together statements on a yearly basis, which I would recommend highly against. But one of the biggest things that delays deals is the financial performance of the company and having the financial systems in place to be able to track where you are from at least a real-time basis. People tend to, when they get into transactions, but one of the weakest parts that we see in a lot of these transactions is the financial systems and the ability to produce financial statements. So that's one of those ones I hit my head, because at the end of the day, it happens a lot. It happens more than you would think. Great businesses, big and small. And it's one of those situations where you get to, why didn't I do this earlier? So
Yeah.
I would start with the financial statements and the financial systems, being able to track real time where you are, because that affects people. One of these things, and then I'll shut up for a second, but one of these things people don't realize is people, if you're doing a transaction, people track you like a public company. They look at your financials every month. They want to see things sometimes weekly. They want to see new volume. They want to see inventory. They want to see backlog. Lots of different things that a lot of people aren't prepared to bring to market or bring forward as they go through the process.
Yeah, meaning, like, having been in deals with Scott, I mean, he gets expressions of interest, he gets them down to a couple buyers. Now all of a sudden he's got a letter of intent that they're going to execute. So, like, okay, this looking like the deal's going to go through. Now we need to do the due diligence, and there's a window of time that occurs. That's when not only does the proctology exam start on the past,
Correct.
but the proctology exam is happening on the current.
Right.
It's what he's talking about. So it's like, if you weren't prepared even to do the past, it's like, so I think what you're saying, Scott, is like, and I promise I'm not paying him, $5 to say that, but like, crappy financial systems is like a totally unforced sloppy error. Meaning,
Right.
like, you may not be able to control customer diversification, but
Right.
you can control that.
That's exactly right. And I tell you, another thing that it really is a gotcha is making sure your shareholders are on the same page. Again, we've been through multiple transactions together, but you find out in the end, families, partners, etc., really what they're made of at the end of the day. And we get into situations where we get a letter of intent, or we get an indication of interest, or we get some kind of view on the company's valuation that we've shared with this company beforehand. And now the shareholders are not on the same page, although one owns X and one owns Y. Shareholder X wants to get more than Y. So there's a lot of things to be said about shareholders being on the same page. And that moves more into the legal side of things with Jack is, you've got a shareholder here and you've got a shareholder here. Now, all of a sudden, people don't feel like they're being treated fairly. So we see a lot of people decide, hey, I own 60% now, but I should get 67% because I did X, Y, and Z. And I know you guys have seen that before too.
Yeah, and imagine, if you will, that little provision in your operating agreement or your bylaws or your shareholders agreement that was drafted 15 years ago that says, upon the unanimous consent of the owners, of the shareholders or the members, a sale of all or substantially all of the assets, right? You forget about that because the minority owners maybe are just along for the ride, and and the majority owners and maybe the patriarch of the family has been running the business and running it how he or the matriarch, how he or she wishes. And then it comes down to, well, wait a minute, now what that section 6.3 in that agreement is very clear that there are some things that are reserved to unanimous consent by all of the owners, including that 2%, 5%, 10% person that has been, hasn't had a voice, hasn't expressed anything until it's time to, well, exactly right, Scott. It's okay. Well, 5% of a $1 million delta is not insignificant to that person, right? So yeah, differing opinions and making sure that you have all that on the financial side of things that you brought up. It is the way it manifests itself is, and the way that we have the discussion with our clients is, well, the fact that this is a mess puts more risk on you. There's less certainty. What does that translate to? Now you start talking about purchase price adjustments, or you start talking about higher holdbacks, or you start talking about earnouts instead of cash. And so, there is a direct impact on sloppiness to the purchase price that a buyer is willing to pay, because you're asking them as a seller to assume more risk based on the history, and is it accurate or not, and then also the projections into the future.
Jack, I agree with you. And one of the things we always tell our clients is share all your warts. I don't care what they were, when they were, what you did. If you've been arrested, if you've done X, you've done Y, share what you can so we can deal with it. And I'm sure everyone on this webinar has seen situations where you get close to the finish line and a background check's done, and all of a sudden something comes up where there's a bankruptcy.
Yeah.
We had one client that had a bankruptcy for $2,000. They said, oh, we didn't think that was important. Well, it comes up in your background check. So be able to tell us everything you've done bad. We're not the IRS. We need to know everything about your business so we can portray it in the best way possible going forward, versus finding out about it later and then having to make it up. As Jack just said, from a risk standpoint, that you start talking about purchase price decreases and different structures and things of that nature.
Yeah, that's right. Adam, you got your hand raised.
Yeah, Scott, kind of another thing that we hear a lot in transactions. So if you kind of think about, okay, what is the actual result, based on your experience in transactions, like, company A, selling the company. I can't tell anybody internally, because if I told people internally, customers would start to hear, blah blah. I need to keep the saying silent for until the last minute. All roads lead through me. Company B, management team completely involved. Meaning like the response to the diligence team, is not one person or two people. It's like 5 or 6 people. Seller's totally open to having the buyer talk to some of the key people in the company. Like, talk to me about kind of, I guess my working hypothesis is that the first way is all nonsense. And that if I were actually on route B, that the risk is sort of a red herring risk that would produce a higher result than going route A. But you know the facts because you deal with people that are in both. You've done transactions where it's both. So you tell us what kind of leads to the better result, because that is a concern that a lot of sellers have.
Agreed. And route A and route B obviously are very different, but route A is more the owner that's afraid, as you said, to get this widely dispersed within the company or within the management team. That to me is a little bit of a red flag. You need to at least share it with your financial person, your CFO, your controller, whoever that may be, and your key people that are involved in the accounts and the revenue generation of the business. That to me is a minimum in terms of how you should share information. Route B is much better. We just did a transaction in February where the entire management team was involved. Different people were pulling different information in terms of diligence. We were all involved, or they were all involved in conversations with the purchaser. And at the end of the day, it was much smoother, because when you limit the amount of people that know, you also limit the information flow. So route B is much preferable. Route A happens quite a bit, just because people are paranoid that, hey, if this person finds out about it, they may, change is inevitable, but they may not take change very well and may try to leave the company. So I think it's a confidence level in the management team and a confidence level in letting them know and it being like an open book. There's some companies that share financials with, everyone in the company. There's other ones that just share it with a limited group of 2 or 3 people. I think the more dispersed the information is within the management team, the better.
And if I think I could pretty well quantify, the effect of open book transparent management on EBITDA itself, but meaning it's higher, when you have it, but which ultimately would create a better value. But do you got any sort of anecdotal, like, hey, the deal closed faster, or we got like one more turn of the multiple, if you're to compare 2 equivalent companies, just one was secretive, one was not?
Yeah, not so much on, the multiple comes out in the information. If you're slow in providing information, the information's messy and sloppy, as we talked about before, it could be a half a turn to a turn multiple difference because you look disorganized, you don't have the right information, and you're not sharing it with the management team. Where it makes a big difference is if that potential buyer, private equity group, strategic buyer, can share information, can talk to the management team, can understand the business. We always let groups talk to management teams before they put an indication of interest forward. And we do that to get a flavor of what the team's all about. Because typically, if you don't talk to them, you're not going to know what the business is about, what the idiosyncrasies are, what the areas of value are. So in answer to your question, it could be a half a turn or a turn more, but talking to that management team allows you to get a better view on value, a better view on revenue generation in the future, and a better view on how these companies fit together going forward and what the growth plan of the business is. Because let's face it, most of these buyers are focused on growth and what they can do and where they can take the business from point A to point B.
So That's awesome, Scott. In terms of the quantification of like what you're leaving on the table by not doing it.
Right,
Which in, kind of the deals that you're doing, that's millions of dollars, by
correct,
not doing it. In other words, like almost guaranteed you left that on the table.
correct.
Jack, from your perspective, you know, people are still like, yeah, I hear you, but the risk, and risk really is impact times probability. So from your perspective, like, have you ever seen it go bad when someone had more people involved in terms of like allowing them to meet the buyer? In other words, like, well, what would be a theoretical risk? Well, Timmy, the lead sales guy, caught wind that I was selling the company, and he maintains a lot of client relationships, and he took, 40% of them out the door, pre-transaction. Like, have you ever, I guess, have you ever, what's the actual risk of doing it? Like, the cost of not doing it, it's millions of dollars, but like, do we have, is there anything to suggest that something bad actually has occurred by being more open and transparent?
Yeah, so plenty of situations where, and it's the difficulty is it's human nature when you have a job and you potentially have a new boss and a new owner. Do I have a job post closing? And so people are in self-preservation, survival mode because they don't know. So that would push you into, okay, bring more people into the fold so they are comfortable and they know that they have a job post closing. And so, but at the same time, yes, I've seen disasters happen, and we were told, or if we represent the seller, we told the buyers and their representatives, this has to be very secretive for at least a little while until we get further along, because if people find out, and they were very honest with us, or somewhat, I don't want to say arrogant, but they were honest with us to say that, this business, without me at the head, they're going to have some hesitation. This has been a family run business, and now you want to turn it into a corporate run business, and you may lose some people, or they're people that are like thinking, maybe, I don't have a future here. I don't want to be part of a big corporation. Like if there's the company's being absorbed into some big company, some portfolio holding company. And so that's the dilemma. And so I have had to, when we represent a seller, be very clear. And then when some information got out, had to have a very stern discussion. And the buyer, I mean, the seller is about to walk, because we told you that, and you guys can't keep your mouth shut. How can we trust you to proceed with the transaction? And and you just can't control your people. Sometimes it's an unreasonable ask of a buyer to do that. I mean, you have to have people in there. So what is kind of the middle ground? We've had meetings at 10 o'clock at night on a Sunday at the property to walk the property, with flashlights, kind of thing. We've had meetings offsite, information that's been shared, not with, the main domain. So it's been personal email. So that way there isn't, other people who have ability to see into emails. So there are ways around that, but it is, I've seen some things pretty much blow up. I've also used it as, I don't want to say I weaponized it, but it was because our client was very clear about it. Now, on the buyer side of things, you have to be reasonable. And so, for a seller to say, these are the only people you can tell this certain information or share this information. Well, you have CPAs, you have attorneys, you have surveyors, you have valuation experts, you have investment bankers, you have all these people. And yes, they're under confidentiality, but to say that, if anything leaks out at all, then that's a problem. Then, is that reasonable? So you'll see when we represent a seller and there's an NDA that goes out there and you have potential buyers, and it's interesting because all of us have been through this, where you see an NDA that we produced on behalf of a seller come back marked up. And what is important to one company, as far as it was, well, you need to keep any of your independent contractors quiet, kind of thing. Well, we can't control other people. So there are variations that come back on the NDA. So it's very interesting. But yeah, it can be catastrophic, but also sellers need to be reasonable and understand that, there has to be due diligence and it has to be done properly, and it's going to be somewhat intrusive. But I go back to what I said at the beginning, which is, you know, the biggest fear and what causes the exodus is the fear of not having a job after the closing, or we've talked about, the guys know, Scott, what we've talked about a lot in the past about culture. And that is the other, probably at the same level of, do I have a job? Am I going to get paid post closing? Is what's the culture like? And is it going to be the same, or is it going to be totally modified? And so if you get the employees and key people over those fears, that's what I've seen has been the most successful.
Yes. Yeah, I completely agree with that. Let's clear out some of the comments and questions. So in the Q&A, Will has asked, hey, if I'm in early stages of talking to a business owner to understand his existing business, it sounds like this is a smaller business because you talk about Schedule C. Is the Schedule C the best choice, or is there something better to ask for? So whether it's a smaller business or a bigger one, Scott, you want to address that?
You know, we Schedule C is obviously nice, but we want to make sure we have the complete financial picture of the company. We want to make sure we know what the expenses are. We want to make sure we know what the owner's privileges are, what we call adjustments. We want to make sure that we understand the balance sheet, obviously, of the business. So it's nice to have, but I think we want to have additional detail above and beyond that to really make sure we understand the whole financial picture.
Here's another question from Joseph. He says, when you buy or sell a company, do you also acquire the cash in a company bank account, or is that excluded in the deal most of the time?
Most deals are cash-free, debt-free. You get the cash at closing. You take on the long-term debt at closing, not the payables or anything like that. You're responsible for the bank debt, but usually cash-free, debt-free at closing.
All right, great.
Can you also, but you might want to address working capital, it being different from, when you're leaving money in the till versus pulling it out, and maybe discussing just generally. We've talked about it before, but I see that as being an issue. And then also, as Adam knows, an issue that should be addressed in the letter of intent rather than waiting until a little bit later down the road when it's like, well, wait a minute, this was your expectations were to leave in the working capital, and then also fighting over what is in the definition of working capital as far as assets and liabilities and everything else, and income. And so anyway, if briefly touch on that differentiation.
Yeah, we've only got 21 minutes left, but yes, I mean, we could spend all day on working capital because people don't understand it, but working capital is the amount of capital that a buyer wants left in the company to operate the business for a certain period going forward. Typically defined as current assets minus the cash, so your receivables, inventory, etc., minus your current liabilities, your payables, any prepaids, or excuse me, any other accruals and things of that nature. Typically, companies look at that on a 12-month average. So you look at each month and you say, all right, my payables, or excuse me, my receivables and my inventory was $7. My payables and others was $5. My working capital is going to be $2 for that month. You look at that on a 12-month basis and take an average. So when you deliver the company at closing, you're going to estimate your receivable, your current assets minus your current liabilities. And that's going to be what your working capital is at closing. The example I just used, if it's a $5 average and you deliver $6 at closing, you get $1. If you deliver $4 at closing, you have to give $1 back, or excuse me, $2 back. So it's a complicated topic, but at the end of the day, what they don't want you, and what someone invented this 50 years ago was, they don't want you to collect all your receivables and leave all your payables in the business. They want to make sure the business is operated on an ongoing basis as it has been operated, and you deliver that working capital to make payroll, to continue to operate the business, pay the company's bills, etc. So we could go on that for another 20 minutes, but at the end of the day, it's a level of capital that's used to operate the business going forward.
And I just want to reiterate also that that isn't the way it goes down in all cases. So there are some cases where the cash is scraped and then the buyer brings in SBA money or investor money or their own money into, and then, you know, it's kind of like at 12:01 a.m. on Monday, that's when they take over the business, and then the business transitions to, you know, the new bank account. They are responsible for payroll and those kind of things. So it doesn't happen in all cases, but a lot of times, I mean, imagine you want to be able to operate the business on day one and not have to worry about, okay, well, wait a minute, you know, how are we paying this bill or that bill on day one? So
yeah, good point, Jeff.
Few more comments that came in the chat just to make sure that we acknowledge. So Ralph had said, when you were talking about, you know, financial systems and statements, how critical that those things are, he says, hey, don't overlook operational systems and corporate governance. Yes, those all
Great.
are critical. And Ralph has done a lot of M&A deals as well. Also, and then Udo says, I once took an MBA level course in how companies develop their SEC 10Ks to present the message that they want and downplay what they want to hide. And that's in publicly traded stuff. I think it's interesting. I think most do to discern the real truth, even if most shareholders are in agreement on the presentation. You know, the point that I want to say about that is, if you haven't heard anything, go back and listen to the front of this thing. It comes down to trust and honesty, because the truth comes out. It always comes out. And the more you can be upfront, like what Scott was saying, like, just, you know, we are not the IRS, but nobody likes surprises. And when surprises hit because you thought you were going to get away with it, you're not, and it's going to hurt you. And I'll give an example real quick. There's a good friend that bought a company to bolt on to his existing company, and he has really good attorneys, and he's not a litigious person at all. But they paid a premium for this other company that was a natural bolt-on, had synergies with the master company. However, that was Chewy. Hey, Chewy. This guy made reps and warranties that were incorrect. And he had a lot of inventory that he said was good, and actually it failed all the quality assurance stuff. So there was a lot of stuff that they're going to have to go, they're going back and they're going to claw this stuff back as part of their payout. And this guy probably thought he got away with it, but he didn't. But you want to make sure, like, do not skimp. And I'm not saying this because Jack's on the thing. I'm saying it because I've seen it. Make sure you have good attorneys by your side that know what they're doing and that have done transactions, not some run-of-the-mill, you know, master of none but jack of all trades, sorry Jack, kind of person. So anyway, enough of my little diatribe on that. But I think we've kind of cleared out the stuff in the chat. Yeah, so we're good. So keep rocking.
Yeah. So Scott, if you could switch gears a little bit in the time we have left, you know, I always feel like with investment banking, you know, it's a lot like the stock market or real estate. You know, hey, there's never a better time to buy or sell. You know, like no matter what, you know, that's kind of the answer. That which you know, some could say that's self-serving because that's how we all get paid. I actually think that the real truth is that because you can't time the market.
Right.
So what, you know, when's the right time to sell? When you're ready to sell. So when, I guess from your perspective though, you know, banks are getting tighter, you know, Can't speak to private equity other than, hey, they're starting to invest in stuff that, because they like CPA firms, you know, as an example, because they've already bought all the dental practices and all the veterinarians. So it's like, hey, I know, let's go after CPAs. Then maybe they'll enter into Jack space and
It's recurring revenue.
yeah, go after the attorneys. So I guess what are you seeing out there in terms of, you know, kind of demand, you know? And there was also, and I guess if you could kind of relate that to, there was also this big talk about all the baby boomers are going to be leaving. So that means it's going to be a buyer's market because there's going to be so many people selling, you know, multiples are going to come down. Like if you just kind of talk to, you know, all that is a broad topic just from what you're seeing in the group, because you're tied in. I mean, you read all the reports, you know, what are the big heads saying?
You know, it's a tale of two cities, really. I'll tell you what we're seeing and what we have seen in the last 2 years. What you're seeing now is less companies coming on the market, but more quality. So you're seeing a huge demand function from private equity groups, from strategic buyers. There's a lot of dry powder. There's lots of people chasing deals. But what you're not seeing is a huge amount of companies coming to market. And I think we're still trying to, as an industry, I still think we're trying to figure that out. We probably have 20 private equity groups who come through our office every month, and they'll tell us, one, they're slow, they're not seeing a lot of new deals. The deals they are seeing, they're getting outbid. So going to your valuation question, Adam, we had a couple of deals, one in February, where we thought it would trade at X multiple, and it traded at X plus 1 because the demand was so high. You know, we had 25 offers for the company. We had a lot of interest in it. It was recession resistant, good management team, all the things we've talked about as a good company. And we basically wrote their own ticket for getting that deal done. So overall, we're seeing less supply and more demand. When you have a good company, as I mentioned, you can write your own ticket. We are seeing a lot of what I'll call B and C assets coming to market, which are harder to get done, take longer to get done, etc. So you are seeing some other companies come to market, and I'm speaking primarily for companies under $100 million in enterprise value. So high level, you're seeing demand very high, supply very low. But then on the other side, you're seeing if you've got a great company, if it's well managed, if the systems are good, etc., you're getting higher multiples than what you would in a typical market. We've seen that evidenced in the last 2 years. Although the market's been slower and you don't see as many deals, the deals that are good, the deals that are quality, you're getting higher multiples. So that's kind of a high level overview on where things are at. The crappy deals always are going to be crappy, and they'll get done, but it'll take a longer period of time. The good deals will always get done, but we have not seen valuations lowered. In some industries, we've seen them higher. HVAC, home services, you know, those multiples continue to be at a very high level. Veterinary hospitals, which we've done a lot of work in, those went through a huge spike in 21. Those have come back to earth, but are still at historically high levels. Certain industries are not going to be that have recession exposure, are not going to trade as high, but they'll still trade at their average levels. So it's really a tale of two cities.
So this one may be like all three of you guys can jump in on it. I know Adam's going to want to jump in on it, but Matt says, talk a bit more about how to best shelter or manage tax liability on the sale of a company in addition to moving to Florida. Who's paying attention?
Yeah, so it's a good question. I mean, you know, and if it's funny because I've got a 5-part series coming out on LinkedIn, of which part 1 was released. Part 2 is filmed and should be out actually today, if it's not already out. You know, that outside of moving to Florida, where you're not going to pay state income taxes on the sale, the second thing is actually just more, it would be more of a longer term play, but converting from your existing entity to a C corporation so you can take advantage of all the provisions related to qualified small business stock. This applies primarily to companies that aren't law firms and CPA firms, you know, or dental practices, or, you know, doctors, you know, which is most everybody else. But if you do that, up to $10 million of the gain per shareholder each year that you receive gain. So if you know, $50 million company did an installment sale, you know, husband and wife own it, you know, 20 million per year could be excluded from gain. If you're a C corporation, you meet the other holding period requirements. So, you know, probably the biggest thing to do would be, if you truly believe that a sale is the route that you're going to go, then planning for that. You know, Jack and I always joke, you know, Scott said it too. It's like, hey, when should you be preparing for a sale, you know, 5 years before you sell? This one like literally is 5 years before the sale. And it's not like, well, you know, at 3 years, can I get 3/5? No, it's all or nothing. You know, so doing an entity conversion change and, you know, kind of doing the stuff that you need to do to avoid the double tax and C corporation is really the biggest one. But, you know, if you miss all that, then the other option that you've got available is to, and I mean, if you know, if you kind of go back to, you know, let's say that, you know, whether there's a tax on unrealized gains or there isn't a tax on unrealized gains. I mean, you know, how many transactions have you done, Scott? Like, I love you and you're awesome at what you do. How many transactions have you done that have been over $100 million to the shareholder?
Less than 10.
Yeah, so not many. And you've been doing this for a long time. So like, not a lot of people are going to be in that $100 million to $200 million unrealized taxable gain, unrealized gains area, which only applies to liquidity. Mostly only applies to liquidity. Point being that, you know, you don't pay any taxes on the money, you invest in the market, and then you borrow money against that, you're never paying taxes. Right. You know, the other route is, let's say you miss all that, you know, qualified opportunity zones are still an option that are out there. Especially if you did a qualified opportunity zone fund, you know, which would be, you know, something that is publicly traded. So I avoid the capital gains tax. And at the same time, I now have something liquid I could potentially borrow money against. That's another good one that I can do the day of. There's other stuff about, you know, charity and gifting to people, but, you know, those are really the big ones, you know, state residency and then your entity classification are really the two biggest ones to focus on.
And I'll add also that going back to your section 1202 comment, which is the section that is the 5-year provision, is that we've had clients who we've suggested that to them in the past, and like, I'm not going to continue with this for 5 years. I'm just not going to do that. You know, it's going to be shorter than that. 5 years goes by very quickly, especially in a time, and there was no way to predict, okay, we're going to have inflation, we're going to have higher interest rates. So it may be that, and what I've seen is sort of a panic in that, okay, I know if I sell the company, then I have to create this essentially an annuity for me in retirement. And with higher interest rates and inflation, I may not get enough money out of the sale. So I'm not going to sell as soon as, you know, so there's all those things that go on psychologically. So, but my point is that 5 years goes by pretty quickly in the scheme of things. When you're thinking about it, you're like, wow, okay, 60 months, really? But so something to consider and seriously consider, because there is a lot of benefit to that. But so anyway, my point is just consider it and don't get bogged down with it being 5 years, because it'll go by quickly.
And the key here is planning. I mean, Adam and Jack, you both said that. You know, you'd think that the average person would come to us 2 years ahead of time and say, I'm thinking about doing X. and Y and Z. The average person comes to us 3 months ahead of time and says, okay, I want to do a deal, or I've been approached by someone. So there's not a lot of interim planning or pre-planning on a lot of these deals. If you're thinking about doing it in the next 12, 24, 36 months, get with your accountant, get with your estate attorney, get with a firm that can help you plan out some of these, because you can take advantage of a lot of these issues if you get ahead of them, instead of just having an LOI with your name on it and a date on it, and all of a sudden the fact pattern's not good for you.
Man, you brought up a really important point, Scott. And what I've seen many times is people have, oh, I've got my general attorney. He's really, he's just part of the family now. And same way with accountants. Hey, we've always had them do it, our stuff. But you got to ask the question, have you done deals, and have you done a lot of them? And are you extremely proficient in these complex matters? Because a generalist at this point, you don't want a generalist, you want a specialist. So it's not to be self-serving, it's to be just honest, get somebody that knows what they're doing, because it's a lot of money, and it's a future, not of just you, but like employees, and like it affects a lot of people. So that's really important. Scott, you have a pretty defined niche on where you like to run. What is that niche?
Typically, companies anywhere from 3 million to 20 million in EBITDA. Variety of industries: healthcare, business services, consumer, and industrials. A lot in healthcare, a lot in all those areas. Geographically, we're national in scope, but it's typically with companies that are 3 million to 20 million in EBITDA, which allows you on the lower end to have private equity groups typically interested in you, and on the high end, both strategics or industry buyers and private equity groups. So we play in that lower middle market, is what it's called, Gary, typically.
Yeah. That's good. Thank you for that. It's funny, middle market, when I was at Bank of America, was 50 million top line to 500. Now it's 2 billion. That's their middle market.
Yeah.
It's crazy. So anyway, it's just interesting to see how 20 years will move things.
Well, Gary, let me interrupt. I mean, you invited me on war stories, and no one on this panel has told any war stories yet. So I want to hear Adam and Jack's war stories and yours. I mean, we still got a couple minutes left, but
mine take way longer.
Yeah, it'll take longer than that, but I think we've actually we've told the war stories, maybe not directly, but I think that in our comments, those are from war stories, right?
Yeah.
And my parting comment for today is because this happened yesterday, is that we talk about having the right people assisting you, but think about it internally as well. Had a client come to me and say, we are so screwed because the person who has all of the information and the knowledge and everything else is ill, and critically ill, and we are paralyzed as a business moving forward because we don't have enough people that know enough information. So my point is also, you think about who you have within your organizations, and is the knowledge focused too much in one person, or literally on one machine? Have your backups for your data as well, because that is a horrible thing to not be able to go back and pull up a backup from yesterday because something happened this morning to your active system. So 2 additional freebies for the day.
good point.
Yeah, I was just with a guy that is a good friend of the firm as well, and he was brought in to help scale a company, and their entire operating system had a bug that got in somehow. I don't know how, but it crashed everything, and it affected all of their backups. So all of the backups were completely destroyed as well. They had to go, and they're in the construction world, they had to move to paper. And it took them 9 months. I mean, it about took the company down, and they transitioned out, but holy moly. That was a
Wow.
war story.
Wow.
It wasn't M&A, but like all of their backups were destroyed. And think about that, man. It's like the digital age is wonderful until it's not, you know. So
Right.
anyway, we'll be back next week, Lord willing. And we'll have to kind of revisit some of these war stories because we have a lot. But we've got a couple things coming up in the next couple weeks. We've got an SEO, search engine optimization, really expert. Like that's all they do.
That's
And
the
really,
internet, Scott. The
I know.
internet.
I don't use it much, but
I know.
I'll be on that one. I'll definitely be on that one.
Yeah, not using AOL. So anyway, if anybody came in late on this thing, we'll be up on the BGW CPA YouTube channel later on this afternoon. Same way with the Shoemaker YouTube channel. Thank you guys for taking the time to join us. Scott, always good to see you. Thank you for bringing your wisdom and expertise to help people, because it really does help people. So
Thanks for having me,
anything
guys.
else?
Yeah, thanks,
Yeah,
Scott.
man.
I appreciate it.
Thanks,
You
guys.
guys did a great job. All right, we'll see
All right.
y'all. Have a great
See ya.
week.
Thank
Bye-bye.
you.
All right,
Thank
bye.
you, Scott.
Thank you.